Hey, what's up, stock compounders? Brad here. So I like this book, Richer, Wiser, Happier, so much that I'm going to share my highlights from another chapter. I've already done chapter 6 with Nick Sleep. I've done chapter 1 with Monish Pabrai. Today I'm going to get into chapter 2 with Sir John Templeton. So let's dive right in to what I really enjoyed from this chapter. First, the beginning is amazing. So the author, William Green, is going to interview Sir John Templeton at his beach community, okay? He gets there a day early, and he spots this guy in the water. Now, this guy has a hat on, he's got a long sleeve shirt on, gloves, and he's pacing back and forth in the water. The water is like up to his neck, and he realizes it's Sir John Templeton. And what Sir John is doing is getting a workout for free in an amazing location. He's using the water as resistance as he's kind of power walking through the ocean. So what that scene really communicates to start off this chapter is Templeton had the willingness to be lonely. He did not care what other people thought. Okay, and that was very important, that principle throughout his investing career. He's not guided by what other people think, what other people are excited about in the market. That's completely irrelevant to him. So I thought that was a cool way of communicating that. It also starts off with a quote here. "It is impossible to produce superior performance unless you do something different from the majority." Okay? It makes so much sense. Most of us value investors know that. But it's important to be reminded because it's very difficult to behave in that way in the markets. And part of the reason for that, as humans, it's been so important to be part of a tribe, part of a community throughout our evolution as humans for survival, right? Like, we need to be close to people. We need people who are watching our backs. And great investors, they tend to have this quirk about them that they don't have this need to belong to a tribe, right? They tend to be playing a one-player game when it comes to investing. Okay. So very independent thinkers, don't care what the crowd is doing. So it takes a quirky kind of individual to really do that well, to stand apart from the crowd, from the tribe. When stocks plummet, the average investor sees others panicking and instinctively follows the tribe by selling out, getting into something safe like cash. The counterintuitive truth about this is this may be the perfect time to buy stocks since they're all on sale. Okay? So again, most of us value investors are well aware of this. But especially for me, it's important to drill that in, because when shit hits the fan, when the market is tanking, it's really easy for that instinct to kick in, to see, okay, what is everyone else doing? And kind of blindly follow the herd by running for the exits. A necessary characteristic of great investors is that they can't be overly influenced by what other people think. A necessary characteristic. Great investors care much more about being right and winning, okay, than gaining social acceptance or approval. I found that particularly insightful. I know Monish Pabrai, just recently, he talks about how he sees investing as a one-player game, and he's really just trying to win the game. And if he has to, copy others, he calls it cloning, it doesn't matter. He doesn't care about original ideas, all right? He's been able to check his ego at the door, and all he wants to do is win the game, okay? Doesn't need to be his idea. He just needs to win the game. So it becomes a lot simpler when you clarify exactly what you're trying to do. Are you trying to win a game? Are you trying to show off to your friends? Are you, what exactly are you in this game for? I think that's really important to answer. Okay, this is a really important point. Absolutely nothing will make a stock drop to an extreme price quicker than other people urgently trying to sell. Okay, this gets back at this idea of not following the herd, actually going against the herd. When everyone is running for the exits, being willing to look at it and say, oh, this may actually be a great time to go in the opposite direction, okay? Because all these people no longer want to be in the stock market, which is driving down prices in a hurry. Could be a great opportunity, right? It's what Buffett says. Be fearful when others are greedy. Be greedy when others are fearful. Okay, so this is amazing. John Templeton started his investing career in the late 1930s. Okay, it's 1939. Everyone still has the taste of the big 1929 crash in their mouths. Wall Street is not doing well. And then you've got this war, right? World War II. It's imminent in the U.S. in 1939. Everyone knows we're headed into war. So what does John Templeton do in this environment where people still don't trust the stock market from the 29 crash? And here's a war coming. There is so much uncertainty, right, when it comes to what's going to happen in the stock market. What Templeton decided to do is he identified 104 American companies in the Wall Street Journal that had experienced such a terrible depression that their stocks traded at $1 or less. Okay? This was his approach. So he calls his broker. He says, I want to invest $100 in each of these 104 companies that have basically been left for dead. Okay? And his reasoning for this is, wartime is probably going to be really good for the vast majority of businesses. All right? That was his logic when everyone else was, feeling the exact opposite way. So the broker, replied to his request to put $100 into each of these 104 stocks, saying that's a very unusual order. But we're going to go ahead with it, except we've eliminated 37 of these companies that are already in bankruptcy. So what does Templeton say? He says, oh no, don't eliminate those. They may recover. Okay? Those could actually be some of the best performers. So he put $100 into each of those 104 companies. That was a big bet, guys. That's $10,400 in 1939, which is the equivalent of like $183,000 today. Okay? Just starting his investing career, plows $183,000 into stocks when everything seems so grim, right? The sentiment is at an all-time low on Wall Street. The future had never looked so bleak, but so much dire news was already priced into the market. And this is the key point here. Templeton thought the odds were stacked resoundingly in his favor. It was common sense, arithmetic, that attracted him to this investment opportunity. The potential on the upside was so much greater than it was on the downside. All right. Now, this is a very difficult. It's hard to imagine being in Templeton's position at this time and making these decisions. It requires tremendous willpower and strength of personality for Templeton to buy at the point of maximum pessimism. Everyone else is running out of a burning building. Okay, that's what it feels like on Wall Street. Everyone is running in the opposite direction. Not only did he have the courage to buy 104 reviled stocks as the country went to war. So that's the first very difficult thing. The second difficult thing, he had the patience to hold them for years, even as the drumbeat of disastrous news grew more and more deafening. Okay? You've got Pearl Harbor happening. You've got war. It just looks bleaker and bleaker that Germany is just going to take over Europe and who knows what else, right? It's just very bleak. But through all of that, for 5 years, Templeton was able to hold these 104 companies. This is how bad it got. The state of New York Insurance Commission actually banned stocks from the portfolios of insurance companies in 1942, deeming them an inappropriate investment. Wow. When he sold 5 years later, he had a profit on 100 out of 104 positions. Okay, incredible. He made roughly 5 times his money in 5 years. Just insane. It was one of the boldest and most prescient investments in history. Okay, so that's really where Templeton got his start, in that kind of environment with that kind of bold bet. No real experience under his belt, but he was able to draw on the few principles that he had been able to cobble together and do that. Just incredible. So let's talk about 6 guiding. We're not going to hit all of these, actually. I think we're going to hit maybe 4 or 5 of them. Guiding principles to help any investor from John Templeton. The first, beware of emotion. Okay, it leads most people astray in investing. People get more aggressive after big gains, right? They have confidence. They take more and more risky bets at the exact wrong time to be doing that kind of behavior. And they get more cautious after big losses, right? As the market drops, people get more cautious, right? Which is the exact time to get more aggressive. So that emotion really, it leads us to do the wrong things at the wrong times. And this is a very famous quote from John Templeton: "To buy when others are despondently selling, and to sell when others are enthusiastically buying, is the most difficult, but it pays the greatest rewards." Fantastic quote. The second principle, beware of your own ignorance. And this is probably an even bigger problem than emotion. Okay, Lee Lu talks a lot about ignorance. Charlie Munger, Warren Buffett talk a lot about knowing what you know and what you don't know, and staying squarely within what you know. Templeton says so many people buy something with the tiniest amount of information. It makes no sense to him to invest that way. Another principle, successful investing requires patience. This is, I think not the latest book, but the second to latest book from Joel Greenblatt. It's all about the secret, right? The secret to investing is patience. Such an incredible, leverage point for investing is patience. When Templeton bought U.S. stocks at the outbreak of World War II, he knew how cheap they were, right? It was clear, he knew how to value a business. He knew what a business was worth, what a share of stock was worth, and what it was trading at, right? He knew it was cheap, but he couldn't predict how long it would take for the market to agree with him, for the market to price those stocks in alignment with that underlying business value. His edge lay not just in his superior insight of identifying what was cheap, what had a margin of safety, but in his willingness to wait year after year after painful year for the situation to play out as he predicted. In order to have a really good investment result, all you need is patience. And, Templeton talks about the story, which Pabrai has talked about in previous talks, of the Dutch buying the land of Manhattan from the savages, the Native Americans, in 1626 for like $26. Okay, $24. I think it is $24. And if the Native Americans had simply invested that $24 at 8% per year over that almost 4 centuries, right? Almost 4 centuries, they'd have more wealth than the land value and all of the buildings on Manhattan. Okay, so it conveys the incredible power of compounding, particularly if you're doing it over, long periods of time. You got to remember, in the compound growth formula for investing, compounding it's really about 3 variables. You have what you contribute, right? And that's linear. If you contribute twice as much, you're going to end up with twice as much. There's no exponential factor with what you contribute. The 2 exponential factors are your rate of return. So in this case, we're fixing it at 8% in this example. And the other exponential is time. Okay, so if you have a long enough time, you can turn 1 penny into more wealth than is currently on the planet. Okay, and that's really the magic of compounding. So patience. The next principle, I really like this one. I'm going to show a value line screener that I think I'm going to go through and build out. If you guys are interested in seeing that, maybe in a future video. The best way to find bargains is to study whichever assets have performed most dismally in the past 5 years. Now, I don't know why 5 years. That's what Templeton uses. Then to assess whether the cause of those woes is temporary or permanent. This is brilliant, okay, guys? Most people are naturally drawn to investments that are already successful and popular with the herd, right? Everyone's piling to, Tesla and Bitcoin and Palantir and all these high flyers, right? Basically anything ARK owns. Now, if a sunny future is already reflected in the price of the asset, then it's probably a bet for suckers. Okay, this is Templeton's perspective. All of this, all this rosy future, this rosy outlook for the business is already priced in. Okay, and it's possible that the future is going to be even rosier than the bulls think it's going to be, right? But you got to really gut check yourself. What is the likelihood of that? It's tough to get an asymmetric upside to downside with popular stocks, popular investments. Where is the outlook the worst? That's what Templeton asks himself. I want to go where people are running away from businesses, okay, from investments. Which one is the lowest price compared to what I believe it's worth? Okay, that's the price to value, the margin of safety that Templeton is trying to figure out. And he quotes the Bible here. As the Bible says, the last shall be first, and the first shall be last. Okay? And, it reminds me when, it's pretty common, Joel Greenblatt has pointed this out, when you track mutual fund managers over time, often the best performing funds over the last year or the last 5 years, are some of the worst performing funds over the next year, the next 5 years, the next 10 years. So, it really is true that there's this force that brings things back to equilibrium. Obviously, that's not always the case. As value investors, we're looking for those investments that aren't going to adhere to that necessarily, right? We want the long-term compounders. Templeton, that wasn't really his framework. He was kind of a 3 to 5 year time horizon in terms of investments. But anyway, that I digress. The next principle, do not chase fads. And this is the last one I'm going to talk about. Do not chase fads. The best way for an investor to avoid popular delusions is to focus not on outlook, not on the story, not on what the business could be, but on value, right? Value today. Investigate valuation measures like market price versus sales volume per share, net asset value per share, average earnings per share for the last 5 years. So really, very tangible measures of what the business is worth, right? So that helps Templeton stay out of trouble. Okay, last page of notes. So this is awesome, guys. 1939, Templeton makes this amazing bet, right? By buying when everyone was fleeing, when no one else wanted to buy. Now, we're in 1999, okay? We're in the dot-com bubble. So what does Templeton do, right? He has a scheme to profit from the dot-com bubble. He decides to target 84 of the most egregiously overvalued internet stocks, all of which had tripled in price since their IPO. After the IPO, this is what Templeton realized here. After the IPO, a lockup period followed in which company employees weren't allowed to sell their shares, usually for 6 months. Okay? And this is a key insight. Templeton realized that these insiders would race to dump their stock at the first opportunity, since they'd be anxious to cash out before the euphoria faded, right? They see, people getting rich all around them. Prices just going up, up, up. And, they can't do anything, right? They can't sell their shares for 6 months. So Templeton had that insight. This stampede of insider selling would cause the stocks to crash. Okay, that was his thesis. So what did Templeton do? Templeton sold short each of those 84 stocks, betting that they'd nosedive as soon as the lockup period expired. So he placed a $2.2 million bet against each stock. $2.2 million. A total of $185 million shorting these high flyers in 1999. And it worked like a dream, right? It worked seamlessly. He earned a profit of $90 million in just a matter of months, okay? Put up $185 million, made $90 million, okay? In addition to getting his money back. So just an incredible bet, right? That's like a 50% return in a couple months. So, the way he bookended his career there, betting in things turning up when things looked bleakest, and then betting that, things were going to head south when everything looked rosy, like things were going to go up forever. Really ultimate contrarian moves here from Templeton that he just knocked out of the park. So I thought that was an awesome way to end this chapter. And the big takeaway, the willingness to be lonely, guys. This value investing game, this game of, high long-term returns, picking individual stocks in the stock market, it can be a lonely game. One of the things I really appreciate about this YouTube channel is that I get to connect with so many other value investors who are trying to do these same things, right? Act against the herd, figure out where the opportunities are. So it's really helpful for me to be able to chat with a lot of you. A lot of you have messaged me on Twitter, LinkedIn. We've been communicating down in the comments, email. It's been awesome, and I'm so excited to see this channel snowballing, because it is lonely, and it doesn't necessarily have to be. Us oddballs can come together in some ways and help each other be better investors. So anyway, guys, that's a lot. I just wanted to share all of those awesome insights from Sir John Templeton. And again, I'm probably going to plow through each of the chapters in this book, Richer, Wiser, Happier. It is an incredible book. I highly recommend, if you haven't had a chance to read it yet, check it out on Audible or Amazon or wherever you get your books. So with that, guys, I will see you all in the next video. Take care.